Negotiating to receive stocks or other investments in place of a paycheck is not common, but it can be a highly strategic move under the right circumstances. Here's why you might want to pursue this path. Wealth accumulation. Stocks can grow significantly over time. By investing in a diverse portfolio, you could potentially see higher returns than from a traditional paycheck. Tax efficiency. Depending on how long you hold your investments, you may benefit from lower capital gains taxes instead of higher income taxes. Market flexibility. By negotiating for a diverse portfolio, you can invest in stocks that align with your personal financial strategy, whether in blue-chip stocks, ETFs, or other securities. Reduced liquidity pressure. Stocks and investments can grow passively, allowing you to build long-term wealth without immediately cashing out like you would with a paycheck. However, this form of compensation comes with risks. If the market declines, your stock holdings could lose value. And unlike a paycheck, the value of stocks can fluctuate dramatically. You also have to plan carefully to ensure liquidity for daily expenses, since stocks and investments can't be used for immediate spending without selling them. Types of investment-based compensation. If you're negotiating for stock or investment-based compensation unrelated to the company, here are some options you can consider. Direct stock purchase. How it works. Your employer purchases a specified amount of publicly traded stocks on your behalf, either as a lump sum or regularly, for example, monthly or quarterly. These stocks are yours, and you can sell them at any time. Upside. You gain ownership of individual stocks with growth potential. You can choose stocks based on your preferences, such as blue-chip companies, emerging tech, or dividend-yielding stocks. Tax consideration. Taxes are deferred until you sell the stock, at which point capital gains taxes apply. Exchange-traded funds, ETFs. How it works. ETFs are baskets of stocks that can provide diversified exposure to different sectors or markets. You can negotiate for a portfolio of ETFs that align with your long-term investment goals, such as growth, income, or sector-specific funds, technology, healthcare, etc. Upside. A diversified ETF portfolio can mitigate the risk of single-stock volatility while still providing market-based returns. Tax consideration. Like stocks, you'll pay capital gains tax when you sell ETFs, often at lower rates than regular income tax if held for more than a year. Mutual funds. How it works. Your employer can set up compensation in the form of mutual fund contributions. Mutual funds, like ETFs, provide diversification, but they are actively managed, which may lead to higher management fees, but could offer more focused investment strategies. Upside. Actively managed mutual funds aim to outperform the market and can be a stable part of a long-term investment portfolio. Tax consideration. Mutual funds are taxed similarly to stocks and ETFs. You'll pay capital gains when you sell your shares. Retirement investments, 401k, IRA, etc. How it works. Instead of receiving direct compensation, you negotiate for employer contributions to a retirement plan, like a 401k or IRA. The employer could match contributions or invest directly in funds or stocks of your choosing. Upside. Contributions to retirement accounts can grow tax-deferred, with potential tax benefits for certain accounts, such as a Roth IRA, where withdrawals are tax-free. Tax consideration. Traditional retirement accounts defer taxes until withdrawal, while Roth accounts offer tax-free growth if you follow certain rules. Index funds. How it works. Index funds track the performance of major stock indices, for example, S&P 500. You could ask for compensation in the form of contributions to index funds, which provide broad market exposure. Upside. Index funds are low cost and provide a diversification, making them a good option for long-term growth. Tax consideration. Like ETFs and stocks, Index funds are taxed when sold, potentially benefiting from lower capital gains tax rates. Preparing for the negotiation. Here's how to prepare for negotiating investment-based compensation instead of a traditional paycheck. Understand your personal financial goals before approaching your employer. Have a clear picture of why you're choosing stock or investment-based compensation over a paycheck. Are you looking to grow long-term wealth? Do you want to benefit from lower taxes? Do you have other sources of income that make a salary less important? It's essential to evaluate your risk tolerance. Stocks and investments can be volatile, and there's always the chance of losing value. You'll need to balance your desire for growth with the need for short-term liquidity to cover living expenses. Research the types of stocks and investments. Be ready to propose specific stocks, ETFs, or funds that you'd like as part of your compensation. Whether it's blue-chip stocks for stability or growth stocks for higher risk and reward, you should know what fits your strategy. If you're unsure, consider consulting a financial advisor before the negotiation. Estimate how much compensation in stocks. Decide how much of your compensation you want in stocks and how much you need in cash. For example, you might ask for 50% of your annual pay in stocks and the other 50% in a regular paycheck to ensure liquidity. Consider the logistics. Work with your employer to determine the logistics of receiving stock compensation. Will they buy stocks directly on your behalf? Or will you receive funds to invest in the stocks of your choice? Make sure there's clarity on how this will be handled to avoid miscommunication. The negotiation process. Now that you've prepared, here's a step-by-step approach to negotiate your investment-based compensation. Step 1. Express interest in investment-based compensation. When your employer offers a compensation package, make your interest in stock-based compensation clear. Example script. I'm excited about the role and the company's future. Instead of focusing entirely on a cash salary, I'd like to explore compensation options that include stock or investment-based assets, such as stocks, ETFs, or mutual funds. This aligns with my long-term financial strategy and would allow me to contribute while also investing in my future. Step 2. Propose specific investments. Have specific stocks, ETFs, or other investment vehicles in mind. Discuss how this would work in place of your salary. Example script. I'd like to propose that part of my compensation comes in the form of a stock portfolio. For example, I'd be open to receiving 40% of my annual compensation in the form of direct investments in stocks like Stock A, Stock B, or ETFs like ETF A. We could also discuss contributions to index funds or a mutual fund portfolio. Step 3. Negotiate the balance between cash and stock. Most employers won't agree to pay 100% in stocks, so you need to find a balance between your base salary and stock investments. Example script. I'd propose a split where 60% of my compensation is in cash and the remaining 40% is in stock investments, either through an established portfolio or a direct stock purchase plan. Step 4. Discuss tax and logistics. Ensure that both you and your employer are on the same page about the tax implications and the logistics of setting up this compensation structure. You may want to consult a tax professional to ensure you're benefiting from the right tax strategies. Example script. Given the tax advantages of long-term investments, I'd like to work out the logistics of how this would be managed. We could set up regular purchases or lump sum contributions to a portfolio. I'd also want to clarify any tax implications on both sides. Tax advantages of stock and investment compensation. Stock compensation can offer several tax advantages. Capital gains tax benefit. Stocks held for more than 1 year qualify for long-term capital gains tax, which is typically lower than ordinary income tax. For example, instead of paying 22 to 35% in income taxes, you might only pay 15% or 20% on long-term capital gains. Planning. By holding onto stocks for the long term, you can defer taxes and potentially pay a lower rate when you sell them. dividends, and dividend-yielding stocks. Benefit. Some stocks pay dividends, which may qualify for lower tax rates as qualified dividends if held for a certain period. Planning. Dividends provide an additional income stream with potentially favorable tax treatment. Retirement accounts. Benefit. If your employer contributes to stocks through a retirement account, such as a 401k or IRA, the investments can grow tax-deferred or tax-free, in the case of a Roth IRA. Planning. By negotiating contributions to a retirement account, you can benefit from compounded growth and defer taxes until you retire. Potential risks to consider. While the potential for growth is enticing, there are risks. Market volatility. Stocks can fluctuate in value, which means your compensation might decrease in a market downturn. Liquidity issues. Stocks and investments aren't immediately accessible for everyday spending. You may need to sell shares, which could be subject to taxes or penalties. Tax implications. If not planned carefully, stock sales could trigger large tax bills. Consulting a tax professional before agreeing to any stock-based compensation is crucial. Conclusion. Negotiating to receive stocks and investments instead of a paycheck is a bold move, but it can pay off significantly if done right. By preparing thoroughly, understanding your financial goals, and proposing a balanced compensation package, you can set yourself up for long-term financial success. Just be sure to weigh the risks and consult with professionals to ensure you're making informed decisions about taxes and liquidity.